Earnings season kicks off this week and next, I guess, if we're also going to consider financials. But obviously there's a lot more going on in the world than just earnings, and a lot of those things are going to affect options and the markets. And we're going to talk about that and take your questions today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, where we talk about options, the markets, and take your questions. Obviously, the real question right now is what is going to happen over the course of the next 24 to 36 hours or so. Are the parties in the Middle East and in Washington going to come to some form of an accord and ceasefire and open up the Strait of Hormuz? That is the question. There has apparently been more traffic going through the Gulf. I'm going to pull, or the Strait, I should say. I don't particularly see it, but I've heard that reported. As you can see right here, this is only a little stale. This gets refreshed about every 10 minutes or so. What we can see here is that there's still not a lot of ships going through that region. We can actually take a look at the table here because Maritime Traffic News does keep track of it, and we can see right here we have had a bit of an uptick, but just bear in mind this is where we were on March 1st. This was already lighter traffic than was typical prior to the strikes on February 28th. So this is certainly higher than we had been seeing through this region right here. We'd seen a couple days, but I think the more important thing is that we've seen a couple of ships that are not sanctioned or shadow. So sanctioned in this case, as we've previously discussed, is referring to ships that Iran has allowed to pass. So the fact that we've seen 9 ships over the course of the last couple of days that were not in that category, I suppose, is an improvement, but we are well below what people should be expecting. Now, as I previously pointed out, we have earnings coming up. Delta is going to be reporting this week. That kind of kicks it off for earnings. This is kind of interesting, of course, because this is an area that has really been pretty hard hit, the airlines, as you would expect. So I'm going to actually look at just the space in general, and then we'll talk about Delta specifically, in part because that was one of the questions that one of our viewers sent to us. By the way, for anybody who's watching, I think we're pushing this out to X live at the moment. But if you want to ask a question, I think you need to be on the YouTube channel in the chat, and then you can post a question, and I will try to respond to it. We don't have a mechanism that I'm aware of yet where we can pull these into the social media feed from X at the moment. But in any case, if you do have an interest, if you're watching it on X and you want to ask a question, join in on YouTube, youtube.com/openinterest, and then join the chat and you can put your questions in there. But Ranjana asks, hi Mike, how would you play Delta going into earnings on Wednesday morning? So first of all, as we can see, just taking a look at the space generally, no big surprise here that it's obviously been in some significant distress since we saw this conflict break out. You can see how much it fell when those strikes first came. I think one of the reasons that we started to see such significant weakness even before that is that there was a lot of rhetoric leading up to that. And of course, we had a military buildup in the Gulf going on. So I think there was some expectation that this was going to happen. That was also to be seen when we looked at oil prices. I'm going to just put the front month WTI contract in here, and you can see that it really started to head higher in January. It was on the 2nd of January. Some of you will remember that the president was essentially telling Iranian officials not to go after their own people and implying or suggesting that there was going to be some kind of price to pay if they did. Obviously, the United States didn't strike for almost another 2 months thereafter, but that's when oil really started to come off of its December lows. And as you can see here, right in mid-December, crude was trading at $55 a barrel. But that's not really just the only issue, because in the midst of all of that, the crack spread blew out. Now, why does that have a whole lot of relevance in this situation? I'm going to get rid of crude here and just go back to jets for a moment. And I'm going to add delta. So one of the principal distinctions, well, there's a lot of distinctions between delta and a lot of the other carriers. Let's talk about some of them. First of all, delta is less dependent on sort of discretionary travel. They have more business travel. They have one of the strongest balance sheets in the business. But when it comes to fuel prices, this is where they truly are unique. So if anybody watching doesn't know, Delta Airlines actually purchased a refinery in the Philadelphia area in 2012, if memory serves. It was 2012, 2013, just going off of memory at this point. Owning their own refinery does not exempt Delta from the impact of rising crude prices. But it does significantly mitigate their exposure to broadening in the crack spread, right? So that's the difference between crude oil and the refined products. And one of the other things I would quickly point out, we saw some cancellations. United Airlines had some cancellations. There was another airline that announced some cancellations today. The spot markets, so basically the local markets for jet fuel, kerosene, are significantly worse than even the front-month futures would suggest. And that's what you normally anticipate. So if you have a really severe supply-demand imbalance in a commodity, and you see a market go from, conventional contango. Contango is when the front-month futures, actually let me just draw this out so we can see it. So contango is when the front end of the curve is lower. As you can see here, this is where we were. I'm going to highlight this so you can see that in blue. That's where we were 6 months ago. Versus, and actually I shouldn't even, I'm going to get rid of 6 months ago. Let's go right to December 15th of last year. I think that was a pretty good comparator. So let's put that in. All right, so this is where we were in mid-December in orange, and white is where we are right now. But these curves are just the futures curves, right? So if you include spot, things can be much worse, depending on the region, because of course the commodity markets are going to be, are going to be regional. How much oil, or in this case really jet fuel, since we're talking about the airlines, is available in certain areas. And one of the things we noticed is that when crude oil was only up about, when it was up about 60%, we saw that Singapore jet, by that time, was already up like 180%, right? So this is really a significant issue. So exposure to the crack spread is larger for other airlines than it is for Delta. And Delta also has a much stronger balance sheet than many. Let's just take a look at that for a second. Okay, so we can see here they've got $4.3 billion in cash, not net cash. They still have a decent amount of debt, but $4.3 billion worth of cash, positive free cash flow. Compare this to, I don't know, let's see how American looks. So they actually have $5.8 billion, which isn't too bad. And if you take a look at more of the consumer oriented airlines like a JetBlue, Southwest obviously was coming off that real disruption that they had. It was a function of their sort of antiquated software system. So that was already quite depressed. They used to be considered sort of unique and best of breed. But one of the things we have seen for sure is that Delta has now outperformed. I'm going to put Jets in here again as our competitor because of these relative advantages. And let's go to that point. You know what I'm going to do is let's look at it from the end of November. And you can see just how significantly it's outperformed. This I find remarkable. I was actually just talking with a colleague about this morning, that Delta is actually higher even though crude prices have effectively doubled over this period, up 4.5%, whereas Jets, which includes Delta, by the way, is down over 4%. So that's pretty significant outperformance for just over a quarter. I do believe Delta is best of breed. I do wish it was not trading, if we can take a look here, we can actually compare where it is on its relative basis to its 2-year historical range. I do wish it wasn't trading at a premium to its own multiples. So the little orange triangles that you see here, that's the historical average for that specific metric. So in this case, BF, this is the best forward. So best is the Bloomberg estimates. It's not best as in superior. It's just Bloomberg estimated forward EV/EBITDA. So that is taking the current enterprise value and the anticipated EBITDA, and it's showing you essentially where it is. But you can see that as we look back on a 2-year range, it's not cheap to its own historical multiple. But then, the airlines typically trade relatively cheap anyway. It's not going to trade at a market multiple. It's not now. 10.8 times forward, 6.2 times EV/EBITDA. But you can see that represents a reasonable premium to the overall group. If we just look now to what the implied moves are, 5.8% is what the options market is currently implying. That seems pretty cheap when you consider, one, the world we're living in right now, and it's going to be, I think, based a lot more on commentary. So when management starts to talk, I have a feeling that they're probably going to, refer to the current circumstances and how disruptive that is. But even before all of that, you can see here just how sharp some of these moves were in the past. So for me, a 5.8% implied move when we've seen, here, 12% move, 23% move, a 9% move. And that wasn't when we were going through something like this. To me, that strikes me as very reasonably priced if you were thinking about trading options on the long side. So let's just take now a quick look at what the technical indicators have to say. So you can see here, and for those who haven't seen this screen before, all this is doing is it's just rank sorting a number of different technical indicators to see if you see a green arrow pointing up, that means that indicator is suggesting a long trade. If you're seeing it pointing down, that means it's suggesting a short trade. If the arrow is itself green, that means it's profitable. So the moving average oscillator, short, profitable, but some of these others didn't time it so well. And parabolic, you can see, is long and profitable. And just to get a sense of how that's working, we can then click on this and see where it got long. And in this case, it got long right here. So of the short-term technical indicators, this one is the best performing over the course of the last year. It is long right here. My thinking is that if you are long it, given the fact that its multiple is not trading cheap relative to its own history, given that management could say almost anything with respect to what's going on, and local shortages of fuel, which is unrelated to the crack spread issue, because of course they have their refinery, but that doesn't necessarily mean there's going to be jet fuel where, if, when, and where they need it. My thinking is that probably the best way to participate here, if you want to be on the long side, would be to use something like a call spread. Because the options prices, I love call spread risk reversals, but in this particular instance, options just don't seem overwhelmingly expensive, all things considered. Let that boot up. And actually, you know what? I have something else I can show you guys today, which I did not have before. And that is this. So any of you who have not seen this, Trade Alert is, well, they're now owned by SIBO. But the guy who founded the company, I've known him for a long time, Henry Schwartz, former BNP trader from many years ago, longtime user of Trade Alert. In fact, I would say that on the institutional side, almost everybody who was on a trading desk probably had access to this thing, because it gave you sort of real-time alerts and you could set things up however you wanted, and it was really easy to interact with. So we can just go in here, blow this up a little bit. I'm going to try to make this a little easier to see. Is that filling the screen? It basically is. Good. Okay. So we can gauge what the option sentiment was in here. Hopefully. There we are. And we can see that the flow was on balance. So 24% of the trades were bearish, 42%. This is the options trades, by the way. 34% were bullish. We can see what the most active contracts were and what they might have been targeting. So we had the April 17th, that expires at the end of next week. The 80 strike calls, those were the most active. And what was the largest trade in Delta today? Looks like we saw a sale of the April 57 strike puts opening. Okay. May 75 calls spread. That was tied, so that's tied to stock. Yeah, so it was those were the. I mean, this is probably one of the reasons why you're going to see that bullish sentiment, by the way. If we're looking at these puts, anything that is a put sale or a call buy is going to be seen as bullish, and the inverse will also be true. So by now, I think my options play should be up. Let's frame up a quick trade in here. Apologize for the delay. Probably should have had that preloaded, but I'm always experimenting with different things. For example, today I'm experimenting with a wireless thing to run the ears I've got in here. And that is one of today's experiments. All right, let's have a look. All right, I'm hearing that my internet is having problems. I don't know why that is, because this is all a hardwired setup, but it ever torments me. Okay, so I don't know that I would go out as far as the default trade here that options play came up with, which is out to June. I'd probably go a little bit shorter dated than that, just because the logic in all of this would be that I kind of want it to go right to the max value of the spread and not get married to the trade for too long. But that was the one that it came up with by default, the 48.65. Actually, let's just take a look. What are those 65s going for? $1.10, actually. It's not bad. So selling an 18 delta call to buy something that's, you know, at or close to or in the money, that might not be a bad approach to take a more risk averse. If you're pressing a bullish bet, that might be kind of the way I'd be inclined to do it. Let's take a look at the term structure as well here. Maybe we can get bit of a calendar play into it, depending on what the term structure looks like. Yeah, I don't know. I'm not really enamored of buying long-dated vol up here. Yeah, I would probably just stick to a straight vertical, given everything that's going on. If you have, you know, a long position, so that would probably be a good way to play that if you're pushing a bullish trade. Okay. Up next, Jim Howard asks, "Hi Mike, Airbnb for a bullish neutral options trade despite its meandering 52-week range." Well, let's have a look at Airbnb first of all. Below the 200. It's not super exciting chart. Let's take a look over here. Well, looks like a fairly mixed bag. You're talking about a meandering range, which means that, and this is kind of interesting, so that, you know, two range-bound technical approaches would include stochastics, Bollinger's, moving average envelopes, and you can see that both of those are actually on the long side here. Now let's just take a quick peek at the fundamentals, see what we have, what the street's expecting. Okay. So we are trading at about a market turn on next year's numbers, but with 16% anticipated year-on-year adjusted EPS growth, which is, that meets the criteria that I'm sure most of you know matters to me, which is that I'd like to see better top line, better bottom line. Bottom line is growing better than the top line. Very nice anticipated free cash flow growth, so that's positive to be sure. And this has 68, just call it 68.5 billion. I'm going to just round those numbers. I'm just going to call it 5.5 billion versus 68.5, which works out to, could that be true? 8% free cash flow yield? What is it that people don't like about the story then? Yeah, I mean, this is a situation where, if you're thinking about that, let's take a look at what's going on here. But if you are thinking about this one on a meandering basis, and you're thinking it's getting to the lower end of the range, this might be one of those places where a call spread risk reversal would make some sense. So what are you trying to do in that case? Get exposure to it here. You don't mind selling off some of the exposure over here. And then, you know, you're going to say, all right, I'm willing to get long, you know, down in and around here, right? So that's kind of the logic. You know, the fundamentals look good. Technically, it's below all the moving averages, which isn't great. Would really like to see it get onto the high side of that, but as we can also see, going back for some period of time, that hasn't necessarily proven to be the most important and critical thing when it came to Airbnb anyway. I'm not sure that moving averages have necessarily been the best possible indicator, but why don't we frame up a trade on this doing that. So actually, let's also just take a look at, so it's going to earnings May 1st. Typically, I would be looking to get into something with a 45-day to expiration kind of a window here. And in this particular case, because they're not expected to report until the beginning of May, this is a situation where if you were to put on a trade like this, so selling a strangle, using that to finance an at-the-money call option, normally you would look to sort of find that nice blend of absolute premium and break-evens, and also an accelerated rate of decay, which would normally suggest doing something like 45 days. So you'd be dealing with May. Now here's the issue with it this time, though. That decay that you're going to see in this thing is actually overstated, and the reason it's overstated is because of event variance. Meaning that what is going to happen here is the implied volatility is going to rise as you start to approach the event. So options that capture the event, their implied volatilities. So if we were looking at that term structure chart before, let me just pull this up again. So what happens to the implied volatility of an option is, because it captures that event, let me get rid of this, the implied volatility is going to go higher, right? So we can see that right here. You know, this is kind of interesting. Look at this. So there seems to be a bit of a difference of opinion about, can that be right? Oh, that's April, okay. And that's May 1st. Oh, that's an expiration. All right, good. I'm kind of glad we worked through this. Let me just double check this. May 1st. Is May 1st a Friday? That's a Friday. They're not reporting. Bloomberg's got this one wrong. That is not going to be... Yeah, so what day was that? So May 20, that's probably a Thursday. So I'm guessing... Yeah, okay. So now let's take another look at this calendar. So we're looking now at when they report their Q1 earnings. So last year they reported it on May 1st. That's where this May 1st estimate came from. The prior year it was the 8th, before that the 9th, before that the 3rd, before that the 13th. Okay. Yeah, I don't think they actually are going to report on the 1st. I think they're going to report, because that's a Friday, I think they're going to report the following Thursday. So that's going to be on the 7th. That's my guess. So the way these things work is that, you know, they have simple algorithms. They just try to handicap and, you know, when the next earnings going to be. Donovan Young says April 29th. Did they announce that? Let's see. April 29th. It seems to me, let's take a look at what their investor relations has to say. That would be early. That would be early for them because, as we can see, the 1st of May was actually the earliest that they have reported. So let's see if they are going to report then. No upcoming events. And they reported on the 12th, the 13th. Yeah, I don't know, Donovan. I think they're going to report on the 8th. I mean, the 8th, the 7th, Thursday the 7th. That's my guess. So everybody, you can start placing your wagers right now. But if they are going to report, what we're really interested in now is there any way to take advantage of that? Is there something baked in the cake that we don't agree with? So this is 24th, this is May 1st. So the options market at the moment seems to agree that it's probably on the 8th, because you can see that the implied volatility, I mean the 7th, because the 8th, which is the Friday expiration, the implied volatility is higher. Similarly for the following week, and even the week after that. So there seems to be some who are might just also be doing it algorithmically. They're bidding that vol, thinking that there might be an event there, but I suspect there isn't. I suspect there isn't. So maybe the answer is 6% implied move, not huge. And the reason I think that's got it wrong is because it's basing it off of that May 1st date. So let's build a strategy that can possibly take advantage of this situation. I mean, it's not going to take huge advantage because the mispricing, such as it is, isn't enormous. But what you could do is you could say, all right, well, I want to own, I mean, even if we just went to May regs and see what we can get for a May 1st strangle in here. I can sell something like that. What are we getting for this thing? Probably doesn't even need to be that far. Let's go to one. I'm going to put these in here. Now, these prices are a little screwy because it's using it's using closing prices. But this, so what am I doing here? My guess is that May 1st that release date is wrong. There will be others that push out estimated dates. So my guess is that you want to own the options that capture the event and get short the May 1st weekly options. Short the May 1st weekly options, and those things should decay away pretty nicely because I don't think those capture the event. So I am breaking up apparently. I don't know. Maybe you can take my picture off the screen or something like that if we're really, and I'll just talk over some of these things. But basically, I believe that you want to be short May 1st weekly options. That's my expectation. Did you take me down? Let's see here. Okay. I apologize for these technical difficulties that we seem to be having. Not sure what's going on there, but hopefully you guys caught that. I think the May 1st weeklies are probably good ones to sell. All right. Youth is wasted on the young. Thoughts on my SPX bear put spreads for 430. Profits 5.67 times the cost if we see a 5% drop. Maybe I'm a pessimist, but I don't see anything good happening anytime soon. You did, if I remember correctly, you did a tight SPX spread, and actually the market sold off pretty sharply the next day. So I'm hoping that that worked out for you. I believe it was you that did that. You are looking at a tight 62. That's a $5 put spread going out to the end of April. I think that's a good bet. I will make the following point though, and that is that the payoff on these spreads is not the max value of the spread when you go further out in time. So if you've identified a specific catalyst and you can find something that's a little nearer dated, so what would an example be? If you traded Wednesday or Thursday options, why do Wednesday or Thursday options matter? Well, because Trump issued a deadline. We don't know what he's going to do. We don't know what they're going to do. But that's a very obvious catalyst. And one way or the other, it could break very sharply. So that would be one of those situations where using these tight put spreads can make an interesting trade. For those of you who are watching right now who don't know what I'm talking about, I'm going to pull this up and just come up with an example really quickly. So we have a catalyst. It's going to happen inside of the next 48 hours or thereabouts. It's the 6th, so maybe I'll go out to the 9th, all right? Just to give myself a little bit of time. And I say, okay, well, what are the chances? You know, maybe I think that there's one chance in 4, for example, that we could see a 5% pullback if something really bad happened. Now, I'm not saying that's not necessarily what I believe is the correct probability, but I'm using it as an example. So that would represent about 6280 or so in the S&P. So I can look at these options and say, all right, well, what does something down around that level get me? So if I'm looking at the 6300s, 6305 to the 6300s, let's just say I could reasonably expect, okay, so the mid-market price on this thing is 435. The mid-market price on this thing is 415. Now, I'm not saying you're going to be able to pick that up for 20 cents, but that's mid to mid, right? 20 cents. Let's say that it's going to cost you 30 cents to get into that trade. Even if you bought it on the offer, right? So if you bought it on the offer, 40 versus 4, that's 40 cents. But let's say you can get that thing off at about 30 cents. All right, so you buy that thing for 30 cents. Well, that means that your max profits are $4.70, right? You're paying 30 cents for a $5 wide put spread. That's 15.7 to 1, right? So the question you can ask yourself is you can look at that and say, all right, well, do I think I would, which side of that trade am I on? Am I willing to get long a bet where I get paid 15.7 to 1 if the market drops 5% over the course of the next, we'll call it 60 hours or so? And the interesting thing, of course, is because these expire in 3 days and settle to cash, it's, you win, you lose, and you're done. So I would just say I don't mind your thinking, and I know you had a trade that worked out very well, but what's going to happen is if you go out to the end of the month, April 30th, and the market dips 5%, that spread's not going to go to the maximum value, the distance between the strikes. An upside call spread, what's it going to be? 30, 40% of the distance between the strikes in terms of value. So your put spread has to be, the call spread and the put spread have to net out effectively, including some cost of carry issues, but they have to essentially work out to the distance between the strikes. So if you have a $5 wide spread, the call spread is going to be worth $2. Then the most of your put spread is going to be worth it's going to be $3. That's if something in the near term happens. So that's the trade-off you're making. So if you're buying it, number one, you're going to pay more because it's got more time to go to expiration. But the amount it's going to be worth if something happens really near term is going to be a lot less than something that just, bang, it expires in the money. So those are you're giving yourself more time for something to play out, but that's going to be more of a trade that we bleed down 5% over a month versus, we take the elevator down. So your thesis is going to play into that. Alex V says XSP instead of SPX and or SPY options. What do you think? So all of these have the better 60/40 tax treatment. The thing that annoys me a little bit with XSP is that I've typically found that the spreads are a little bit wider than they are even in SPX. So SPX on the screens is a little wider typically than SPY is. Let's take a look at SPY, right? We'll see. And actually, this is going to be as of closing prices, so it's probably not the best example because things will widen out a bit. But I'm going to just back up a little and we will pick, let's just take a look at the same options. And then I'm going to go back in time a little. So these would be the 630s or thereabouts. Let's see what the 630s were as of the close. They were 2 cents wide, right? And now let's go to XSP. Oops. XSP, by the way, is 10th the size of SPX, so it's essentially comparably priced to the SPY options. The thing I like about the index options is that they settle to cash. And in general, I prefer European options that settle to cash. Just gets rid of a lot of unnecessary noise, which I like. So we'll go over here. And these, which are still ticking, are 36.46. And I've just found that, so we traded these several years ago. I was using them when every single time we were trading SPX spreads and we were looking for a little bit more granularity. I would trade some SPX and then layer in some XSP to get us to exactly the notional exposure that we wanted. And I found it a little bit perplexing that I was actually struggling to get the mid-market trades off at a price that would have executed immediately in SPY. So your mileage may vary. I like these products in general. I understand the utility of XSP relative to SPY and would normally recommend it all else equal, but all else is not equal. In my experience, in terms of price, I found that the bid-ask spreads were wider and just getting executions done was more difficult. SPY, trades like water. All these things should. There's sufficient liquidity here. And SPX, you can definitely trade it in the middle. So even if you see that it's, a half a vol click wider in vol space bid to offer, if it would trade in SPY, it'll trade in SPX. And I like the cash settled European option a little bit better. But XSP, I feel like the execution is not quite as good. Again, my experience, and that's a couple of years old, just so you know, because I got annoyed and said, you know what, I'm done with this. I don't want to deal with it because it would just take longer to get a trade-off. And then you want to go focus on something else. So do you really want to be distracted by all of that? Yeah, it's not for me. So it's an excellent question. I think it's a great product. I wish it traded like SPY did, or SPX for that matter. But in my experience, it didn't. So the other thing is that if you're trying to trade something in the complex book, so if you're working a spread in the complex order book, again, SPY it trades really easily, very handy. On the bigger SPX trades, that might be more likely to be a pit trade or something like that. I mean, I don't know. Probably not a lot of you using phone brokers, but yeah, my 2 cents on XSP versus SPX versus SPY. Bob says, thoughts on Netflix ahead of the quarterly earnings release next week? It tried breaking 100 on an upgrade but failed. Riding the May 100 long calls. Break even. Shall I sell 105 or 108 against it? Yeah, this is, I think I've said on a couple occasions that I really think that Netflix is best of breed in streaming by a good margin. I think they were wise not to chase Warner. Go ahead. Let Peace Guy, let Paramount overpay. A little bit of maybe it's unfair, I say a vanity project, but look, I don't think Ellison would be out there looking to buy this company if he wasn't backstopped by a very deep-pocketed father. I can say that, CNBC calling me on the other line. I think we are at a critical level. So I just blew it out to 5 years, 150. So I think this is kind of an interesting juncture. I still like the stock, and that could be the catalyst to punch it through. So I do like spreading it. And let's take a look at how expensive the options are. Not particularly. 6.5% implied move. Yeah, I mean, if you're long the pars and you get a chance it bumps up to them or runs a little bit through, then you can go ahead and look to sell some of them against it. Look, I would sell like a 10, something like a 107, 108 against it on a rally. And frankly, I might even think about selling a downside put if it dips, if I'm going to hang on to those 108s, or if I wanted to roll down and get more upside exposure, I might roll the 108s, your pars into a risk reversal if it dips. So if we just take a look at where this was recently. So if everybody's just wondering what it is I'm talking about here, I'm going to get rid of these moving averages. So obviously we had a nice little pop in here. That was on the news that they weren't going to pursue Warner and pay up for it. But if we come back into, say, this level right here, okay, and at that point your par calls, par being common trader parlance for the hundreds, so your 100 calls are over here. Now, if this thing rolls over, you might say, you know what, I want to roll my hundreds down. But if you do that, you're going to be committing more capital to the trade. But if it's down in this region, then I might be more comfortable, say, selling puts in this region, like around the 85. So if Netflix rolls over, pull your par calls down, and maybe go into like an 85, 95 risky. And if it gets through the 150, probably like to see it above that and confirm. I mean, you saw where we were, so let me just put that 150 back in. So you want to get through and then sort of confirm before you have some more meaningful comfort. And, we didn't close above. So you want to go up, maybe check back and bounce. But, then you can possibly sell some upside against it. So that's probably the way I'd play that one. Your 100 calls. When? April 16th expiration. Okay. All right. Yeah, Donovan, that was you suggesting that your earnings were going to be on the April 29th. I'm going to guess. Everybody place your wagers. Put it into the chat. If anyone wants to go on the record, if you're not actually committing in options trades to it, when do you think earnings are going to take place in Airbnb? Do you think it's April 1st? Why or why not? For me, that's a big fat no. I've explained on this channel many times how you can kind of pick out that that's what I call an obvious error. The algorithm just is dumping the anticipated earnings date on the wrong day. That's as big a hint as I'm going to give you. So April 29th, April 30th, those are two options, or the 7th or some other day. Put your comments into the chat. When do you think it's going to be? But that is my expectation. I think it is going to be on the 7th of May. All right, let's see here. Tonight, FinWest. Good morning, Mike. Happy with a 3-day holiday to get an added day of sleep, get energized for earnings season. Did someone from Unusual Whales accept your invite to come on the program yet? Actually, thank you for reminding me, because they did say they wanted to do that, but we didn't come up with a date. So I will reach out to them and hopefully get one of them on. Either this or one of the other shows that we do. So anybody who's a first-time viewer, we do these sort of free forum, chit-chatty, answer your question types of things going on 4:15 Mondays and Wednesdays. I typically have Mark Guthner, co-author of The Options Edge, former colleague, good friend, and professor at Rutgers, join me for what we call office hours on Tuesdays, middle of the trading day, which is kind of nice because then you get to see and talk about things that are actually going on rather than just after hours. And then for the Yield Max folks, I do a live stream on Thursdays called the Co-Down on Thursdays after the close. So hopefully you guys can join for one or all of those. All right. Oh, May 13th. I got someone's voting on a May 13th. All AIs are saying May 13th. Okay. If that's true, if May 13 is right, okay, I'm really glad that this is coming. It's a good conversation, and it's a good way to think about things. So if the 13th is correct, rather than the 7th, what's the best way to play this? Well, what you want to do is you want to take advantage of some mispricing in the vol surface. So we're going to bring this back up. And now what are we looking at? This is That is May 8th. So that's Friday. That is the highest point on the vol surface right there. Okay? So, all the AIs, all the artificial intelligence is telling you that it's going to take place on the 13th. That's after this. This is the 15th. And this is regular way expiration. Or is this? Here we are. Yeah. No, that's not. This is right here. I look at this vol surface. Okay, so who's creating this? That suggests that the 8th captures it. And it could be wrong. That's the best guess of the people who've been trading options, plus where Jane Street, Susquehanna, Bluefin, everybody else like that. That's where everybody like who trades options is sort of pricing it. But if that's wrong, that does create an interesting opportunity, because what you want to do, if that's true, is you want to be short the options that don't capture it and long those that do. So I would say that you could, I mean, it doesn't really matter whether you're going out to, we'll just leave June in here for the sake of argument. But what I would love to do then is sell. So I'm going to be long a put and a call, and I'm going to be short both. But this is going to be the 8th. And let's take this, we'll make that like, can even go even higher than that. Say sell the, oops, yeah, we'll get long the 145s. So I'm going to pick some, you know, I'll make like a 110.45, something like that. This could even be 115. And then get short the same strikes nearer dated. That would be kind of my way to play that. Little strangle swap action. The logic being that these nearer dated options are overpriced. And they certainly are overpriced if they don't capture the event. Because, as we previously saw, they're pricing one in. That's the issue. That clearly looks like an event variance hump in the vol surface. So the normal thing that you would see if you just had a handful of options, the options that don't capture it are low, the ones that do are high, and then the vol surface slopes down like that if it was going to be smooth, right? This would capture it, and then this doesn't. And obviously everything coming after does capture it. It expires after the event. So there are some out here that are going to capture multiple events, like this earnings plus the next one, which would be another way to kind of capture this too, because the vol crush might be slightly less for options that capture 2 events. So if you're looking out to August 6th, so if you had, for example, an August long option, and you could sell, I would sell a March 8th against, a March 1st against it. And if the 13th is right, then a March 8th also. But I'm not so sure. I'm going to go with March 7th as my guess, despite what the AIs say. We'll see. We'll see who's right. All right. Open interest, poor man's poly market for earnings dates. Yeah, I suppose. Let's see. Where did I? There's a. Oh, here we are. Dennis, hello, Mike and team. A second opinion additional to the friends at Schwab. Some unusual put activity seen in Clorox. Okay, well, let's take a look and see whether there is some unusual activity in Clorox. See what we got. Well, let's see. Options volume breakdown. 2 times average daily put volume. It's not huge, though, right? So 2,800 contracts versus 1,235 on average. This is partially because this doesn't trade huge numbers of contracts, but let's see what we got. April 90 puts traded on the offer, and that was definitely the offer. So you can see here, 2,200 traded 18 cents. The market was a nickel at 20 when that happened, and it was opening. 45 vol. Pricey for a staple. Interesting. Okay. Well, let's see what's going on with Clorox then. What's going on the calendar here? When do they report on the 5th. But these are next Friday's puts. Yeah, we can see they were opening because there was only 618 contracts. What's on the calendar here? That is interesting. So somebody's making, go back, is this some sort of a critical, I guess that, what is going on here? This is really quite an interesting situation, this. We're at 11-year lows right now. I guess that's why vol's so high. And 18 cents isn't a whole heck of a lot to spend. I don't know what the catalyst is. Obviously, it's technically a complete disaster. I had my former boss was short this a while back, and this was his thinking. Bleach is just a commodity, right? And Clorox is just a label. So he could never quite understand why someone would pay a material premium for the Clorox brand of a commodity product. Now they've done a couple of things to try to differentiate themselves. At one point they had bottles that had a special no splash design. They put some additives in there, scents and things like that, that would change it up a little bit. But I did get where he was coming from with that. As you would expect, I don't actively promote a lot of short ideas here on the channel or anywhere else for that matter. Just find that finding good shorts is not an easy thing to do. But I think everybody who's watching right now, who's watched me before, would know that this one does not get on the long side for me, because we've got none of the things we typically care about. Top line growth, bottom line growth, free cash flow growth, none of them apply here. But it is getting to a point now where it is starting to look a little bit cheaper. I'm wondering what the catalyst is that somebody was thinking when they bought those. It is possible sometimes someone starts dipping their toe in the water and says, you know what, this thing has just gotten too cheap. $6.80 is what next year's, so that's basically the next 12 months worth of earnings is anticipated to be. That's, we're getting pretty cheap at this point. 15 times and not a terrible free cash flow yield. 6%. This isn't exactly where I typically like to get involved in the dash for trash, really beaten up names. I kind of like to see that, 10 handle on the multiple or a little bit lower before I really begin to get interested when it comes to looking for really cheap names. But that could be what's going on. That is one of the things that I could potentially see is that somebody says, you know what, this thing's getting cheap enough. We want to start buying it. Buy some cheap protection, though. What the hell? In case we're just timing this a little poorly. Because what you're dealing with is catching the falling knife. So you'd feel pretty bad if you started loading the boat with this thing. And, in defense of that theory is, why is the stock up so much today? That would be one of the reasons, right? Buy some puts in stock. That could be it. That's my theory. I've chewed up an hour of your time today, and that's my theory, is that some bargain hunter might be picking up a little bit of stock. That might be part of the reason why it had some relative strength today, and said, you know what? We can pick up some really cheap puts, because those are cheap. They paid 18 cents. That would be a theory for what's going on there. Don't know if it's the right one. But we'll have time to find out on one of the future episodes when we can look back and see whether this stock trades to 80 or makes its way off of these 10-year lows, 11-year lows, and actually catches a little bit of a bid here. So until that time, like, subscribe, hit the notification bell, and put your questions into the chat on the YouTube channel. We will review those questions. And if you put them in soon enough, maybe I can get them in front of Mark Guthner as well, and he can opine on them when we do office hours tomorrow at 2 o'clock Eastern Time. So until then, thank you all very much for watching.